So if you're a contractor with a spouse-owned LLC, your tax filing depends less on the LLC and more on your state. Same business, different rules. In today's episode, we'll walk through one community property state and one separate property state, California and Florida, and why the outcomes change so much in each state. So without further ado, let's get started. So for a spouse co-owned LLC, let's start with the IRS default position. From the IRS's perspective, one owner is usually a disregarded entity. Two or more owners are usually a partnership. That rule applies regardless of whether the owners are married. So when a husband and wife initially form an LLC together, the IRS initially sees two owners operating a business. And the default result of that is partnership taxation, which means a separate tax return for the business, Form 1065 and 1K1 for each spouse. That's the baseline. So everything else we talk about in this video is the exception to that default rule. So why do spouses get special rules? The reason spouses get special treatment is because state property law matters for federal tax purposes. Some states treat married couples as two separate economic owners. Other states treat married couples as a single economic unit. And the IRS respects those differences. That's why two contractor couples can do the exact same thing and end up with two different tax outcomes. So let's talk about one example. Let's take a California contractor couple, and California obviously being a community property state. So imagine this couple is married, lives in California, runs a general contracting business. Both spouses are listed as members of the LLC. So in California, anything acquired during marriage would be community property unless specifically excluded. Because of that, the IRS allows a husband and wife LLC in California to be treated one of two ways: as a partnership or as a single disregarded entity. If the couple chooses single disregarded entity treatment, the LLC is treated like it has one owner for tax purposes. The business activity flows onto one Schedule C, and no partnership return is required. From a day-to-day perspective, the business still operates as an LLC. The liability protection stays in place, and the tax filing is more streamlined. This also applies if the LLC owns rental property, equipment, or a side business related to construction. The key point is that California law allows the IRS to see the spouses as one tax owner, if they elect that treatment. So why do many California contractors prefer this? So number one, it reduces compliance costs. It avoids unnecessary forms and additional tax filings and tax prep fees, and it keeps reporting straightforward. That doesn't mean it's always the best choice, but it's definitely an available option. So let's take a Florida example. Let's see how this would work out in Florida. Florida being a separate property state. So we take the same exact couple, we move them over to Florida. Same business, same LLC, same ownership split. So Florida is not a community property state. In Florida, spouses are treated as separate economic units by default. So when the IRS looks at this LLC, it sees two separate owners operating through an LLC, which leads right back up to the default rule, partnership taxation. That means the LLC must file Form 1065. Each spouse receives a K1, and income is reported on Schedule E, page 2 of the 1040. So same structure, different state law, different tax filings. Qualified joint venture status applies only when spouses own an investment directly. It does not apply to businesses operated through an LLC. So once the business is inside an LLC, in California or Florida, qualified joint venture status wouldn't apply. So how should contractors think about this? So entity structuring is not just about liability protection or professional appearance. You also want to be checking off correctly ongoing compliance issues, tax reporting complexity, and the cost first benefit with all this. In community law states, the IRS does give a little more flexibility, but in separate property states, the structure tends to be more rigid. Neither is good nor bad, they're just different systems. The goal is to choose a structure knowing how it will be taxed so you don't have any surprises later. So if you have any questions on this or you need help setting any of this up, feel free to book a time or calendar. The link is down in the show notes. Hope you found this helpful and see you in the next one.